The Florida real estate bubble isn't just leaking, it's experiencing a catastrophic rupture that's sending shockwaves through the entire Sunshine State. What we're witnessing in these 12 markets isn't merely a correction or a temporary dip, it's a fundamental collapse that's already outpacing the devastating crash of 2008. In the last 6 months alone, property values in these critical areas have plummeted by up to 28%, with some luxury segments seeing drops as steep as 35%. But here's what's truly shocking. According to leading market analysts and hedge fund managers who've been tracking these trends, we're likely only seeing the tip of the iceberg. Expert projections suggest potential declines of up to 40% by year's end, with some areas potentially facing even steeper drops when factoring in insurance costs and climate risk assessments. Welcome back, everyone. Today we're embarking on a comprehensive journey through Florida's rapidly transforming real estate landscape. What I'm about to share isn't just another market analysis. It's a detailed examination of a perfect storm that's been brewing for years. We're talking about the convergence of skyrocketing insurance rates, unprecedented climate risk assessments, a mass exodus of foreign investors, and a fundamental shift in population dynamics that's reshaping the entire Florida housing market. Before we dive into specific markets, let's understand the macro factors at play. Florida's property insurance rates have increased by an average of 238% across high-risk zones in the past 18 months. Over 15 major insurance carriers have either left the state or declared insolvency since 2022. Foreign investment, which previously accounted for 21% of all luxury purchases, has plummeted by 60% year over year. And perhaps most tellingly, new mortgage applications in these 12 markets have dropped by a staggering 43% compared to last year. Let's start our journey in Jacksonville's South Side, our number 12 market of concern. Once heralded as Florida's emerging tech hub, this area is now telling a cautionary tale that every investor needs to hear. Walking through these streets today, you'll notice something that would have been unthinkable just a year ago. Rows of for sale signs lingering in front of properties that would have been snapped up in days during the market peak. The numbers here are stark. Median home prices have dropped 12% since January. But that's just the surface story. Inventory levels have skyrocketed by 178% year over year, creating a massive oversupply that's putting downward pressure on every segment of the market. Properties that once sold in an average of 22 days are now sitting stagnant for 89 days or more. New construction projects, which once dotted the landscape, are now frozen at 63% completion rates as developers grapple with financing issues and dwindling buyer interest. The tech sector layoffs have hit particularly hard here. Major employers have reduced their footprint by an average of 34%, leading to a ripple effect through the entire market. Young professionals who once flocked to the area are now leaving in droves, with rental vacancy rates jumping from 4% to 17% in just 6 months. When you combine this with insurance rates that have spiked by 44% in coastal zones, you're looking at a market that's experiencing a fundamental restructuring. Moving down the coast to Daytona Beach, our number 11 hotspot, the story becomes even more concerning. This once vibrant vacation destination tells a tale of tourism decline and market oversaturation that's sending shockwaves through both the residential and commercial sectors. Property values haven't just dipped, they've fallen off a cliff, with luxury segments seeing declines of 15% or more. But the real story here is in the vacation rental market. Occupancy rates have plummeted by 32%, turning what were once profitable investment properties into cash flow negative albatrosses. Property owners who previously enjoyed healthy 7.2% returns are now struggling to break even at 3.8%, and many are operating at a loss when factoring in the doubled insurance costs since 2023. Speaking of insurance, let's break down these numbers in detail. The average property insurance premium in Daytona Beach has increased from $2,800 annually to $5,900 in just 18 months. For properties in flood zones, the increases are even more dramatic, with some owners seeing their total insurance costs approaching $12,000 annually. This insurance crisis has led to an 89% increase in foreclosure rates compared to last quarter, with many owners simply unable to keep up with the mounting costs. Naples, our number 10 market, presents perhaps the most dramatic example of luxury market collapse we've seen in Florida since the 2008 financial crisis. This coastal region, which once attracted wealthy buyers from around the globe, is experiencing what local real estate veterans are calling the Great Luxury Exodus. Let's dive into the numbers. Properties in the $1 million plus segment have seen average price reductions of 28%, but some ultra-luxury properties are seeing cuts as deep as 40%. New listings are flooding the market at an unprecedented rate, up 156% year over year, indicating what many analysts believe is the beginning of panic selling. Investment property vacancies have surged by 47%, and rental rates in luxury condos have fallen by 23% as demand evaporates. The driving forces behind Naples' decline go beyond simple market dynamics. Recent environmental risk assessments have downgraded significant portions of the coastline, leading to insurance complications and lending restrictions. Property insurance rates have nearly tripled in some zones, and several major carriers have completely withdrawn from the market. Perhaps most tellingly, foreign investor participation, which once accounted for 35% of luxury purchases in Naples, has dropped to just 12% in the past quarter. If these market conditions have caught your attention, you're not going to believe what we've uncovered in our top 3 areas. The data there shows market deterioration that's unprecedented in modern Florida real estate history. But before we get to those shocking revelations, let's continue our journey through Florida's shifting real estate landscape. Moving into the heart of Florida, Orlando's tourism corridor, our number 9 market, presents a troubling picture of what happens when a region becomes over-dependent on a single industry. The areas surrounding major theme parks, once considered bulletproof investments, are experiencing unprecedented market deterioration. Property values have dropped 19% since their peak, but the real story lies in the commercial sector's collapse and its ripple effect through residential markets. Let's break down the numbers. Commercial vacancy rates have skyrocketed to 24%, up from just 7% 18 months ago. Major hotel-adjacent properties, which once commanded premium prices, are now selling at discounts of up to 30%. The data shows that 43% of vacation rental properties in the corridor are operating at a loss, with average daily rates dropping from $289 to $179, barely covering operational costs. The residential market tells an equally concerning story. Foreclosure rates have surged 112% year over year, with investment properties leading the wave. New construction has ground to a halt, with permit applications down 82% from last year. Perhaps most tellingly, major developers have canceled or indefinitely postponed over $2.8 billion in planned projects, citing market uncertainties and financing challenges. Tampa Bay's waterfront, our 8th market of concern, is fighting a multi-front battle that's reshaping its real estate landscape. Once considered a relatively safe harbor in Florida's property market, Tampa Bay is now grappling with insurance costs that have risen an astronomical 215% in flood zones, forcing many longtime residents to sell and deterring new buyers. The numbers here are startling. New construction permits are down 68%, with several major developers abandoning projects mid-construction. The median home price has dropped 17% since the market peak, but in flood-prone areas, the decline approached 25%. Infrastructure upgrade costs are proving to be the final straw for many property owners, with recent assessments suggesting needed improvements could cost upwards of $4 billion over the next decade. Recent environmental studies have painted a grim picture for Tampa Bay's waterfront properties. Sea level rise projections have led to revised flood maps, with 28% more properties now falling into high-risk zones compared to just 2 years ago. This has created a cascade effect. Insurance premiums have skyrocketed, property values have plummeted, and buyer interest has evaporated. Boca Raton, our 7th market of concern, exemplifies the perfect storm hitting Florida's luxury communities. The once stable market has seen luxury condo values drop by 22%, but that's just the beginning of the story. HOA fees have surged by an unprecedented 89% due to insurance costs, creating a monthly expense burden that's forcing many owners to sell at a loss. Let's dive deeper into the numbers. Property tax reassessments have shocked owners, with some seeing increases of up to 40%, based on peak market valuations. The aging demographic shift is accelerating, with 34% of luxury properties now listed by owners age 65 or older who are looking to exit the market. Infrastructure maintenance costs have soared, with some communities facing special assessments exceeding $50,000 per unit for necessary repairs and upgrades. Please take 2 seconds to help me out and hit the like and subscribe if you find the video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now back to what I was saying. Fort Myers, our sixth market, continues to struggle with post-hurricane recovery, but the challenges run much deeper than natural disaster aftermath. Property values have plunged 25% year over year, with some areas seeing even steeper declines. Insurance claims from recent storms have created a ripple effect through the market, with many properties becoming effectively uninsurable. The data here is particularly concerning. 47% of rebuilt properties are struggling to sell, often listing at 30 to 40% below pre-storm values. Insurance availability has reached crisis levels, with only 3 carriers still writing new policies in the area. Environmental risk assessments have led to lending restrictions in 38% of the market, effectively freezing many potential transactions. Miami's downtown and Brickell area, our fifth market of concern, tells a story of oversupply and market correction that's sending shockwaves through the entire region. Condo prices have dropped an average of 20%, but some luxury towers are seeing declines of up to 35%. Foreign investor pullback has accelerated, with new development cancellations up an astronomical 234%. The numbers paint a stark picture. Luxury condo inventory has swelled to 42 months of supply, up from just 8 months a year ago. Insurance costs are crushing HOAs, with average monthly fees increasing by 127% in some buildings. New assessment data shows that 31% of recently constructed high-rises face significant maintenance issues related to their floor-to-ceiling glass designs, adding another layer of concern for potential buyers. Palm Beach County's coastal region, our fourth market of concern, exemplifies the challenges facing Florida's luxury coastal communities. Price reductions averaging 24% in the luxury market understate the true impact of the current crisis. Flood insurance costs have exploded by 312% in some zones, making properties effectively unsellable at any price point. The data is overwhelming. Property tax appeals have surged 189%, with success rates approaching 73%, a clear indication of rapidly declining values. Foreign buyer retreat has left a vacuum in the market, with international purchases down 82% from their peak. Climate risk assessments have led to lending restrictions in 42% of the coastal zone, effectively freezing the market for many properties. Now, as we approach our top 3 markets, we need to prepare ourselves for data that's simply staggering. These next areas show market deterioration that would have been unthinkable just 2 years ago. The confluence of factors affecting these markets has created conditions that many experts compare to the worst of the 2008 financial crisis, but with unique characteristics that could make recovery even more challenging. So Petersburg's downtown area, our third most concerning market, presents a case study in how quickly market conditions can deteriorate when multiple risk factors converge. The condo market hasn't just corrected, it's collapsed, with values down 26% and still falling. Insurance costs have forced a wave of listings, creating a supply glut that's overwhelming buyer demand. The numbers tell the story. New development projects valued at over $1.2 billion have been halted at 42% completion. Storm surge risk reassessments have led to insurance premium increases averaging 275% in affected zones. Infrastructure upgrade requirements are estimated to cost property owners an additional $83 per square foot over the next 5 years, making many properties financially untenable. Fort Lauderdale's beach area, our second most concerning market, has become ground zero for Florida's real estate crisis. Property values haven't just declined, they've plummeted by 27% since their peak, with some submarkets experiencing even steeper drops. But the raw price decline doesn't tell the full story of what's happening in this once thriving coastal market. Let's break down the insurance crisis that's crippling this market. Average property insurance premiums have skyrocketed from $4,800 to $18,500 annually in beachfront zones. In an unprecedented turn of events, 42% of property owners are now paying more in insurance than in mortgage payments. The data shows that 28% of properties in the area have been denied insurance renewal altogether, forcing owners into the state-backed Citizens Insurance at rates up to 340% higher than their previous premiums. King tide flooding has become more than an occasional inconvenience. It's now a market-defining feature. Recent studies show that 64% of beach area properties experienced some form of tidal flooding in the past year, up from 23% just 5 years ago. The city's $1.8 billion flood mitigation plan has sparked heated debate, with property owners facing special assessments that could reach $45,000 per unit over the next decade. The foreclosure rate tells an equally troubling story, up an astronomical 267% year over year. But here's what's different from 2008. These aren't primarily subprime mortgages failing. These are high net-worthy property owners strategically defaulting because the carrying costs have become untenable. Market data shows that 38% of recent foreclosures were on properties purchased with at least 40% down payments. And now we reach West Palm Beach, our #1 market of concern, where the data paints a picture of market deterioration that's unprecedented in modern Florida real estate history. The luxury market hasn't just corrected, it's crashed by 28%, with some ultra-luxury properties seeing declines approaching 45% from their peaks. The numbers here are staggering. 73% of planned development projects have been either abandoned or indefinitely postponed, representing over $4.2 billion in halted construction. Recent sales data shows that 82% of luxury properties are selling below their 2022 purchase prices. With an average loss of 32%, the market for properties above $5 million has essentially frozen, with only 3 transactions closing in the past quarter, down from 47 in the same period last year. The insurance situation in West Palm Beach has reached critical mass. 7 major carriers have completely withdrawn from the market in the past 18 months. Properties in flood zones are seeing insurance costs approach 4% of their value annually, making many homes effectively uninsurable through traditional markets. Recent data shows that 34% of property owners are now operating at a negative cash flow when factoring in all carrying costs. Infrastructure concerns have become a major market factor, with recent engineering assessments revealing critical vulnerabilities in 42% of coastal properties. The estimated cost to address these issues exceeds $2.3 billion, with individual property owners potentially facing special assessments ranging from $80,000 to $250,000 per unit. So what does this all mean for investors and homebuyers? Let's break down the implications and opportunities in this transforming market. First, let's understand the key factors driving these changes. 1. Insurance crisis impact. 78% of affected properties have seen their total carrying cost double. Insurance now represents 25 to 40% of monthly ownership costs. Only 3 major private insurers remain active in high-risk zones. State-backed insurance programs are approaching capacity. 2. Climate risk assessment. 47% of coastal properties face lending restrictions, flood zone expansions affecting 38% more properties than in 2020. Infrastructure upgrades costs averaging $112 per square foot, rising insurance deductibles often exceeding $50,000. 3. Foreign investment patterns. 67% reduction in international buyers. Currency exchange pressures affecting 42% of luxury sales. Shift from investment to end-user purchases. Dramatic reduction in all-cash offers. 4. Population dynamics. Domestic migration patterns reversing in coastal areas. 34% increase in outbound moves from affected markets. Aging demographic accelerating sell-off. Younger buyers priced out by carrying costs. For those looking to navigate these challenging markets, here's your actionable strategy guide. 1. Timing considerations. Market bottom projected for Q3 2025. Insurance market stabilization expected by 2026. Infrastructure improvements completing 2027-2028, and population trends stabilizing by 2026. 2. Alternative market opportunities. Central Florida inland regions showing stability. North Florida markets maintaining value. Secondary cities with diverse employment bases, and areas with completed infrastructure upgrades. 3. Due diligence priorities. Comprehensive insurance availability check. Flood zone rating verification. Infrastructure age and upgrade schedule review. HOA financial health analysis. Population and employment trend research, and special assessment risk evaluation. What we're seeing in these markets isn't just a correction, it's a fundamental restructuring of how we value coastal real estate in Florida. The insurance crisis is forcing a complete reassessment of property ownership costs in these areas. Infrastructure concerns and climate risk are becoming primary factors in property valuation. The Florida real estate market is undergoing a historic transformation. While these 12 markets are showing serious distress signals, it's crucial to understand that it isn't the end of Florida real estate. It's an evolution. Smart investors are already positioning themselves for the recovery, but with a new appreciation for sustainable carrying costs, infrastructure resilience, insurance availability, climate risk mitigation, and population stability. Remember, every market crisis creates opportunities for informed investors. The key is understanding not just where the market is today, but where it's heading tomorrow. Stay informed, stay analytical, and most importantly, stay ahead of the curve. Thank you for joining us for this in-depth analysis of Florida's changing real estate landscape. Don't forget to like, subscribe, and share this video with anyone who might benefit from the crucial market intelligence.